Welcome to the Commercial Real Estate Podcast powered by First National. I'm Aaron Cameron. With me, of course, Adam Pwadek. I'd like to thank our sponsor of this real estate video series, Qualico Properties, as we record live here at the Edmonton Real Estate Forum. Our guest for this episode is an individual named Denis Jones, the president and CEO of Devereaux Group. Dennis, thanks for coming on.
Oh, thanks, Aaron. Thanks for having me. Thank you, Adam.
So this will be interesting. We won't spoil it. Dennis has a little bit of a different background than many of our guests that typically come on here. So Dennis, why don't you give us an explanation of what your history is and how you ended up in real estate?
Sure. I started my professional career as a doctor, first as a family physician, and then I specialized into pulmonary and critical care medicine, and practiced in Regina, Saskatchewan. I specialized down in the United States in San Diego and Miami, and everyone wondered how I ended up in Regina. But a great place to start a business. And a couple of years into my practice, I started looking for places to put capital. I came from a construction background. My family was in construction, and so I started placing capital into multifamily properties in Regina. And in 2010, 2009, 2010. When the oil boom hit Saskatchewan, you couldn't find anything to buy. And so I decided that I needed to start building them. And so in 2010, started our own construction company, and raised capital, really starting with my doctor friends. And that was the birth of our private equity arm of our company, was medical capital. And then grew in Regina until 2014, when we expanded into Winnipeg, 2017 to Edmonton, 2020 to Calgary, and now we're active in all four markets. In 2020, my wife gave me the ultimatum: it's either medicine or building, and choose one. And so here I am.
Was that just time availability? She wasn't seeing you too much, I guess?
That's correct. Yeah, it was 16, 18 hours a day between the two, and so yeah, it was just something had to give.
Where did the name Devereaux come from?
So in 2008, when I started the construction side, I partnered up with a gentleman by the name of Kevin Gelsinger, and he had a small company called Devereaux Homes by Devereaux. And so we really liked the name Devereaux, and it was neither of our last names, so it was sort of unique from that standpoint. We asked some local marketing companies what they thought of the name, and then we sort of, as we grew, we revisited that with national branding companies, and everybody just liked the name. It was sort of sophisticated. It was sort of unique, and so we went with it. And he actually got the name from Mrs. Devereaux on I think it was one of the Falcon Crest or one of those shows back in the day. So yeah, just interesting where he got the name, just liked the name, and so he put it into his company.
Funny, and how much that defines who you are in your life now is this the random way that name came about. Yeah. So you're in four sort of markets in the Midwest. How many units?
So we have right now just over 5,500 units stabilized and in our stabilized rental portfolio, and we have 3,700 units in our development pipeline, about 2,500 in active construction, and about 1,200 that are in the development permit stage.
And how big were you when you decided to pick just one path? You go back to 2020. What was the portfolio like then? Because obviously you're leaving a pretty solid career. How big was the portfolio then to attract you to you as a full-time basis?
So we've been adding about 1,000 units a year to our stabilized portfolio. So we were about 3,500 units under management at that point. And our pipeline was probably about 2,500, 2,800 at that point, just rough estimate. So we're growing our pipeline as well. We've taken advantage of we took advantage in 2020, 2021 when really nobody wanted to be in Alberta, and we went into Calgary and came to Edmonton and managed to buy some really great parcels of land, and so that was part of the reason why we grew the pipeline the way we did, was just opportunity at the time. We felt that Alberta was going to rebound, and it has all historically it always has. So there was no reason why I wasn't going to do it again. And we were patient. We thought we might have to sit on it for 5 or 6 or 7 years, but a year later, 2022, just everything started going crazy.
So COVID didn't rattle you at all then, I guess, because switching to real estate, not that the medical profession didn't have its own challenges during COVID, obviously, but real estate obviously had some turbulence in 2020. But you were still, you're pushing ahead, forging ahead, even despite some of the fear in the market.
Yeah, I think from our standpoint, we're a very conservative firm. While we're aggressively developing, we've always been very well capitalized. We're always, we believe in, the debt is a risk, and that we try and keep our debt at reasonable levels, low levels by many people's standards. And so, of course, COVID rattled us. It was, worrisome. But as we got into it and realized that it was, it was an essential service, and it was deemed that way through COVID, and that we continue to build with challenges. But we didn't think that housing was ever going to stop. The requirement was ever going to stop, and so we felt like I was on a good path. The company was on a good path.
Before we get into the details of kind of what you're building and where, and more of the nitty gritty, I suspect you're not now raising funds from your doctor friends.
No, we've moved well beyond that. Most of our capital is internal. We invest a lot into our own projects, and so typically about 20% of our capital comes from ourselves, and that's myself and my senior management team. And then the vast majority comes from family offices, small institutions, sort of ultra high net worth individuals.
And how's that fueled your growth, and how's that transpiring today? We've heard that it's much more difficult right now to find investors than it has been in the past. A lot of uncertainty on the equity side, and particularly with inflation where it is, where the cost of capital it is, and other parts of the market. I mean, we hear from pension funds and life insurance companies that they're having to redistribute their, what they have amount available for real estate, because it just isn't, it isn't risk-weighted, adjusted returns don't make sense in today's environment.
Yeah, so we look at capital as two different pools. One is our development capital, and the other is the capital that we keep in, we use in our stabilized portfolio. The development pipeline obviously has a little bit more risk, but the yields are higher, and the stabilized portfolio has less risk, but your yields are a little bit lower. So on the development pipeline side, we have no problem raising capital. We've always targeted an IRR of 20 to 25 on our development pipelines, and we're hitting that. I mean, this our last project in Calgary. Our IRRs were closer to 30. And so, finding development capital has been, very, very easy. We've got very sophisticated partners across the country, and that are committed to supporting our vision. On the stabilized side, it's a little bit more difficult, especially with GICs. Recently as high as 5.5%, 6%. It's a little bit more difficult to convince somebody to put money into a stabilized portfolio. We offer a 5% note plus capital appreciation. Over the last 2 years, we did 15.5% on our main fund, and last year we did 19.5%. So we're getting really, really good returns, but historically more like an average of 12 to 14. So it's still a superior return, but you're tying your capital up for a little longer, and so people who family that might have invested $5 million might only invest 2.5, and they put the other 2.5 into GIC to keep it more liquid.
Is it GPLP or is it open-ended fund? Like, how do you work that?
We're a GPLP setup.
So they're invested. If they're doing a fixed, if they're doing the term investment, that's a 5 or a 10-year minimum requirement. How do you manage that?
Yeah, so we're on a 3-year cycle. So we invest into the limited partnership on a 3-year term. We take investment during the term as well. So as we acquire new properties and we raise capital, that might only be on a 1-year term if you're only 1 year away from the liquidity event. But every 3 years, within plus minus a year, we're having a liquidity event. So we allow ourselves some flexibility. Our board of directors, we have a fully independent board. And our board will look at our liquidity event, for example. Next one's coming up in July. And then the board has the ability to say, we're going to push that off a little. We're going to, fine tune it. And so, but, and typically we stay within that 3 years plus minus one, is where we have our liquidity.
When was the last time you sold an asset?
About 2012, 2013. Yeah. So
Great.
we typically keep everything.
The tried, tested, and true investment strategy. Just buy and hold forever.
That's right. Yeah. And our portfolio has evolved. When we started off, having spent 6 years down in the United States and spent 6 years in rental communities down there, the United States has been 20 years ahead of us from an amenity standpoint and from what they offer in their rental complexes. And so when I started building, I brought this concept of amenities and clubhouses and swimming pools and things back to Western Canada. And the first financing that I tried to do on that, the bank said, no, you're going to have to build that yourself out of your own capital and prove it to us. And thank goodness we were able to show that, we get better rents and we get, better retention of tenants. And so now we're building sort of anywhere between 6,000 and 10,000 square foot clubhouses in all of our communities. And it's a very positive addition.
Like, how many units do you need to support like a clubhouse of that size and make it viable for a project?
So the sweet spot is sort of the 300 to 350 units. It starts becoming viable at about 180. Under 180 units, you start again, depending on what you want to put in, it starts making less sense. We're very focused on talking to our tenants and finding out what they want. And so, lately we're putting in large WeWork, areas. We call it D-work. But these are well received. We've got people working in them, from early morning. We sort of have a coffee offering there as well. And so they grab their coffee, they work from home. We have Zoom rooms available for our tenants. And so in order to get the facilities we want, we typically, as I say, need to have a minimum of about 4,000 to 5,000. That's the minimum. Ideally, more like 5,000 to 6,000 on the smaller side, and then 8,000 to 10,000 on the larger side. So in order to pay for that 4,000 to 5,000, you need that 180 to 200 units.
And are your competitors engaging in amenity war at all? In Toronto, the amenity war is in full swing. So is this a reality for you too?
Yeah, it's absolutely. It's arrived. It probably started about, I'd say, 2 to 3 years ago. It really everyone started doing it. Up until then, there were very few people that were adding amenities. There were a few, but as far as the bigger builders, bigger rental builders, they sort of hadn't really got into it, but now they have.
There's a challenge with amenities that often it's a marketing ploy, but then in reality it's not used to a true benefit. And do you find, how do you balance that? I mean, I guess maybe it's some failures, some things have been more successful than others. Is it tenant selection? Like you gotta have the right people. You might have 200 units supporting that clubhouse, but if it's a bunch of people that may not benefit or want it, it's a waste. So how do you manage that, the right tenant versus the tenant that'll pay, use those amenities?
Absolutely. It starts in our design phase, and when we do our market research and we look at the demographics in the market, not all buildings are equal, and not all areas are equal. So we look at the demographic, we look at what we think our rental community is going to be. We typically, our typical demographic is about 85% of our tenants are between the ages of 22 and 35 years old. And that's what we go into areas where that is the sort of predominant demographic, and then we focus our amenities on
that demographic,
on that population. And so some places we won't put a pool in because we don't see a lot of young children, and we find more seniors will not use it. Other younger areas where we see young families, and we have bigger, more 2 and 3 bedroom units. We know that there's children. The pools are used incredibly well. So Yeah, there's some flex, and it all starts with what is the demographic of the area.
What's an amenity you thought would be well used that isn't?
Um, you know, for the most part, I think the one that is least used is the wet bar. You know, we put them, and we still put them into all of our complexes. You know, it's a full sort of kitchen / wet bar. You know, and it's sort of, you got a pool table and games area, and you think that people are going to bring a 6-pack down and put it in the fridge and have a game of pool. It doesn't really happen that often. I mean, it happens, but it's, you know, the things that are far better used are, you know, the swimming pool in the summer, the outdoor fire pits, and outdoor communal barbecues and communal outdoor kitchens, the WeWork IT areas. You know, those are the things that we really see getting used a lot. The games a little bit, but less so.
Yeah.
We talk about potential challenges in the market. Obviously, you've been in an incredible growth phase, but you need a cooperative market in order to keep this kind of growth going. Any storm clouds on the horizon that you worry about?
Yeah, I think the sort of my biggest worry is you know, we're really we're growing the rental product now in the country, you know, at a pace probably higher than we've done in a long time. And that's sort of been spurred on by the population growth that we've seen recently. And my concern is that a lot of the population growth are temporary residents. And, you know, in Alberta, out of the 202,000 people that came here last year, 39% were temporary foreign residents. So whether that be foreign students or whether it be foreign workers. And so when those people, if they choose not to stay, or if their work permits or student visas are not renewed, the demand supply sort of balance sort of may go into imbalance. And you can't turn the supply off quick enough, you know. So when you see that population slowing down, you see that vacancy starting to rise, but you've got these thousands and thousands of units that are in the process. I think there's a risk.
Can I present a counter argument on a short-term basis? The student visas and temporary foreign workers are almost all renters. So at least in the very short term is beneficial. High percentage of renters in that crowd. But
yeah, absolutely. And we're loving it. We're loving it now, and we hopefully will love it for a long time. But my concern is when they stop that, if the government turns off those visas, then what does that do to the supply demand?
And you have 3 development sites underway at that time, and yeah, of course.
What's the average rent for your new builds that you kind of are building towards to make the economics work?
So it depends on the market, Aaron. We're you know, in Calgary, we're seeing probably the highest rents out of the 4 markets that we're in, where we're sort of right around on average about $2.50 a square foot. Where we get out to Regina, and we're sort of more around that $1.90 to $2 on average, and Winnipeg and Edmonton sort of are sort of between there.
Yeah, and so the reason I ask is, you know, Vancouver is 5, 6, I don't know, something around there. Toronto is close to that same level. Yeah. Ottawa's north of 4. I mean, Montreal's north of 4. I mean, that, like, from a affordability perspective, interprovincially anyway, like there's a lot of room for attracting people and
room for rents to grow.
And now we've been in we've been in Edmonton now for 2 days, talking to people like yourself about the economy and just the attractiveness of Alberta at large. And it's not a boom or bust economy anymore, I don't think. Like it's diversified enough that you're not relying on a really strong oil to be attractive. It really doesn't matter where oil is anymore, I don't think. You correct me if I'm wrong. So I think because of the affordability, I think there's still, hopefully, I mean, I hear you, there's some challenges on the horizon, but there's enough attraction to supplement that loss of the temporary residents.
Absolutely. I mean, and we did see very strong inter-province migration to Alberta. Saskatchewan and Manitoba had less, but you know, they did have some. The affordability factor is great. I mean, we see that as a big draw card for people out east that are struggling and people in Vancouver, and we think that that's going to continue for some time. It also is it's a great place to be when you're sort of half the price or even 40% of the price of other markets, you sort of feel like there's only one way that your rents can go, and that's up. And so, we're very bullish for our portfolio that that's
Yeah, I'll
renting at
tell you,
those levels.
developers, and particularly in the major urban markets across the country, are envious that you can build to a positive yield at a $3 a square foot or less, right? Like they're having to squeeze to $6.50 just to make the math make sense, and often it doesn't still right at that level.
Yeah, and I think even for Calgary, I was just looking at the most recent rentals.ca data, and despite the fact that Calgary had a 40+% increase in rents over the last 18 months, they're still number 17 in the country. Like they're still not even in the top 15 most expensive markets. And Edmonton I think it had moved up to 31, and Regina was at 35, and Winnipeg was, I think, at 30. So it's there's still we're in three markets, so right at the bottom of that sort of top 35.
Why do you think that is?
I think construction costs, time to construction in the markets we've been in has been far better than the major eastern markets in Vancouver. I mean, I'm based out of Victoria now, and I see developments in Vancouver and Victoria that are taking 5, 6, 7 years to complete, and so your construction costs and your development costs on that timeline are so much higher that you have to push the square foot rent. Whereas right now we can take Edmonton is especially builder friendly and developer friendly, and we can go from a piece of land to shovel in the ground in well under a year if we're focused, and you just can't do that in other jurisdictions, and Calgary's not, if you know what you're doing in Calgary, it's not much over a year. Just between 12 and 18 months, you can be shoveling the ground as well. And Regina and Winnipeg are also great markets to develop in. So when you can be into the ground quickly, and you can get your product up and operating and generating cash flow faster, you can charge lower rents. And so I think there's not the demand there's not the need from the builder and developers to charge those high rents, and so the renters have benefited.
Any worry about rent control in this market?
Terrified.
Is it a legitimate threat, though? Do you think it has any legs to?
Well, with Saskatchewan and Alberta being the only two markets that are not in rent control, I think there's always a threat because somehow in the other provinces, the governments have decided that it is a good idea. So I would hope that our governments in Saskatchewan and in Alberta see that it is that it's not beneficial. And when you look at the cost of or the average rent, and you look at the availability, Saskatchewan and Alberta have some of the lowest rents in the country and some of the best availability, and they're the two that have no rent control. So that speaks volumes for the fact that rent control doesn't work.
Yeah, I think you just outlined why it's not needed. If you can allow us to continue to build quickly and meet the demand with the supply, then rents aren't going to go up. That is the best form of rent control.
Absolutely.
It doesn't play well in the press, though. That's the only issue.
No, it doesn't get votes. That's the obstacle, right?
Aaron and I would be remiss if we didn't bring up financing. Obviously it's a key component of anybody's development strategy. How do you approach finance in your portfolio?
Yeah, so on our development side, we use a lot of conventional financing. I would say about 60% conventional, about 40% CMHC with the MLI Select program. We find that the reason why we don't use more is, for example, in the Calgary market, the affordable rates that CMHC is using right now are just so far below the market that we don't see the benefit in it, and we don't look to take maximal leverage. We're only using about 75% debt during the construction phase. So that drives us more to the conventional market. On our stabilized side, we're 99% CMHC insured mortgages. We believe in long-term 10-year terms, and we go into the typical sort of 40-year AMs. And we're getting really good coverage in 10 years right now. The spreads have got really narrow. I mean, today we were told that we can get a CMB plus 38 basis points. So it's getting pretty tight there. I'm
Did
not sure how you guys are going to make money.
Yeah.
Yeah.
Did you take a lot of debt during 2020, 21, or when rates were the lowest they've ever been?
Yeah, we did. We did on our conventional side, we did a lot of blend and extending. So we sort of, if we had 2 years left, we extended it out to 5 years and we blended the rate. So we did a lot of that on the conventional side. CMHC, we had less opportunity, but obviously anything that we could finance, we stretched the amount. So we did get right down, and our fund is an average yield for over 8 years of just around 3%. So we're
Great. Good for you guys.
Good.
So you're more of a spectator with the current turmoil in the debt markets and not receiving the blunt end of it.
Yeah, absolutely. On our stabilized side, we're really well hedged against it. On the development side, we feel the pain along with everybody else. We don't like a prime rate of 7%.
So what's next? Are you sticking to your sort of the 4 core markets that you're in? Is there a desire to grow out of the Midwest? What's the
come to
what's
Toronto
the,
and chase some $7 rents?
What's the next sort of 5 to 10 years look like for you guys?
Yeah, so I think from our standpoint, Alberta is a large part of our growth. Having started in Regina and then Winnipeg, we've developed extensively there, and we've got over 2,000 units under management in each of those markets. So, we're going to continue to build there, but we'll slow that down a little. But Edmonton and Calgary, we're planning on pushing up to 5,000 and more units per market. So we see the next 5 to 7 years really being Alberta centric from a development standpoint and building in these markets. And then, we're always looking at new markets. We're always looking at major metropolitan areas. And if we don't see opportunity in Eastern Canada, then it may very well be into Western United States. And we're looking at markets down there.
Do you have any prelim information on that? I mean, I know that yields generally are better there, but the risk profile is a little different. What's your initial kind of view of that market tell you about investing there versus like deploying dollars here?
Yeah, honestly, we're just starting to look at the markets. I don't have any words of wisdom, but what I can tell you is that there's a fair amount of pain down there right now. People overpaid about a year ago for product, and it's come off quite substantially. People are trying to finance the product out, and rates are just not great. So. Right now, we're looking at potentially going down and buying product down there.
Versus built product, yeah.
Built product,
Okay.
yeah. Because I think there's going to be a period in time where I can buy it cheaper than I can
catch
build
the bottom of the cycle, right? Yeah.
So that's what we're looking at, and we're looking at. I mean, the markets we're looking at. Are Texas, some of the biggest centers in Texas, Arizona, Colorado. So it is.
Interesting.
Markets.
That's and why the pivot? Just again, yield or something different, or size and scope?
Well, I think we're just concerned about when the bust comes. I mean, in every construction cycle, there's always an end to the boom. And right now, you walk around the Edmonton Real Estate Forum, and you would swear that it was never going to end. The enthusiasm and the exuberance is overwhelming.
Especially Alberta too. That's like just a good times forever, and then.
But
so you've seen this movie before.
Well, we did. We saw it in Saskatchewan in 2015, and when oil came off, and we went from 1% vacancy to 10% vacancy in a matter of sort of 12 months. So we've seen this movie, and so we want to just be we want to be prepared, and we want to have a diversified strategy.
One question before we're done: do you ever miss the medical field?
I miss the medical field every day. I just don't miss the nights and the weekends and the call and the sleeplessness. And so, I'm very happy with my decision.
Okay, good.
So's your wife.
Yeah. My wife is as well. Yeah, 100%.
We are out of time. I want to thank Qualico for sponsoring our speaker video series today. Of course, the Real Estate Forums Group for hosting us here at the Edmonton Real Estate Forum, First National for powering the podcast. But most of all, I want to thank our guest for sharing his time with us today. Thank you.
Adam, you're welcome. Thank you very much. Aaron, thanks for having me. It's great.